Hi everyone, welcome back to another episode of Invest Power series today. I thought I want to discuss a little bit about a question which I'm sure a lot of people have been wondering in the current environment. You've seen all these online lenders like UBank, Athena, reduced home loans, they're offering incredibly low variable interest rates or even fixed interest rates. Should you be using them? I guess that's the question that I want to explore today, to give everyone a bit of perspective on the pros and cons of using them, and just so that you can make an informed decision in terms of whether these online banks are suitable for you or not. So the first point I want to cover is that most of these online lenders are actually not ADI, what we call authorized deposit taking institutions. Now, why does that matter? Because first of all, what that means is it gives you a true offset account. Now, a lot of these online lenders will actually advertise to say they offer 100% offset transaction accounts as well. But in all reality, if they're not an ADI, not offering a 100% offset account in that sense. Okay. So what do I mean by not 100% true offset? Basically, that's, say for example, you open up a new 100% transactional offset account with one of the online lenders, and what happens is you'll notice that if you set up your loan as an investment interest only, notice here it's interest only, not principal and interest repayment. What happens is if you put the money into the 100% offset account, expecting that, let's say for example, the money in the offset is going to be reducing your home loan and therefore the interest that you're paying, then that's not the case. So to give you some perspective, let's go through an actual example. If, say for example, your home loan today is $200,000, you've got $50,000 money savings account available, and you want to be able to use that to offset the interest that you do. So with the traditional banks, what you do is you ask them to put through an actual 100% offset account, put the 50K in there, then essentially what happens is the interest that you pay every month is reduced because of the fact that $200,000 minus the $50,000 in the offset account, which means you're only paying interest on $150,000. However, with a non-ADI, in other words, these online lenders, what they usually do is if you put $50,000 in their offset account, what happens is your monthly repayment is still the same. So, for example, if the monthly repayment is $1,000, then essentially your monthly repayment will still be $1,000, even if you put the $50,000 in the offset account. But that $1,000, essentially just breaks it down to, you'll be paying most of that is actually going to be paying down the principal. So that's why it's a very different type of 100% transactional account for online lenders versus the one that's actually against the traditional lenders. And there's an extrapolation to last point. These online lenders, most of the time, they cannot actually handle complex loan structures. So for example, if you would like to release some equity from the home, what they do is, all they can do is they can actually release that money as a redraw to you. So you'll still have one loan, but essentially they top up the loan and they give you that money maybe in the savings account. But the problem with that is if you're going to use that money, that equity that's being released to you in a redraw for investment purposes, and while your property is for owner occupied, then that loan is contaminated, because as you can imagine, the original loan amount that you already have, and now you actually want to release a bit more loan amount, so that extra loan amount is to be used for investment purposes. How would you be able to calculate the interest differences, from your own occupied purpose portion versus the equity release that you're using against the investment? So that structure can be very messy if you're trying to do it with an online lender. The proper way of doing it in a traditional lending, traditional bank environment is, you'll set up two different loans. One is the main loan, which obviously, you still continue to pay owner occupied P&I. And the second component of that is essentially the equity release, and that will be used as an investment purposes, and therefore that's a much cleaner way to be able to split them up into two loans and also have two separate offsets account that actually offsets the loan for different purposes. And I'm sure your accountant would agree with me in that perspective. That's the proper tax structure, proper loan structure to set up when tax time comes. So that's another one of those pros and cons that you need to be mindful, is that these online lenders most likely cannot do complex loan structures that you may want to do. Now, another thing with these online lenders, while they're very, very cheap in terms of interest rate offered, a lot of times they're also very stringent in terms of their assessment criteria. So as an example, most of them will probably not look at anything over 80% loan to value ratio, because anything over 80% loan to value ratio will be classified as more risky borrowings, and they don't want any risky borrowing. So I think there's a good saying in terms of this that I believe if you're a good borrower and a qualified borrower, then yes, you will always be able to get good interest rates in response. However, if you want to fall outside the criteria, you need to borrow more than 80%, that type of scenario, then potentially, again, things could change. Potentially these online lenders may not be the best for you to consider. So just keep in mind, it's not all about interest rates. You do need to understand a bit more about what sort of things they're seeking, and before you pull the trigger with them. And the last thing I want to cover with these online lenders is essentially you're the owner of pushing things through. What I tend to find is, because these online lenders, in order to be able to save costs, they obviously have very little staff to an extent, or offshore staff to an extent, and these people are usually loaded with heaps and heaps of applications, as you can imagine, because the front end interface is all through web browsers. So therefore it's very easy for people to be able to just put through applications, upload the supporting documents, and bang, the application goes through for the back-end people to assess. So in the back end, it's usually very busy, I'm assuming, and in that sense, then you may submit the application, upload all the documents, and then you won't hear back for a week or so, depending on how busy the lender are. So you just need to make sure that if you are going down these online lenders, you will need to have the expectation that you're going to have to follow through yourself. So it's a DIY service. You're going to have to prepare all the stuff, upload it, and got to keep following up with the lender that you're looking at going with, and just checking to see where's my application at, etc, etc. Whereas for traditional banks, most of the time, they obviously have assigned credit assessors, etc, so that you'll have a specific contact, whether that's a relationship manager from the bank or a mortgage broker that's going to be your point of contact in terms of the application. So in that sense, the online lenders, you're going to have to do DIY, you're going to have to chase a lot just to make sure that things go through, and that process could take months. I've seen something like 4 months to 5 months, or even 6 months, depending on how complex the deal is and how long it takes to get deals through. With a traditional bank type of application, what you do is you're being fed with information. So, mortgage brokers obviously kept you updated. The relationship manager from the bank obviously will do their best in terms of keeping you updated, so you're not constantly chasing for information. Hopefully, I mean, there's always exceptions, but most of the time, at least you know who to contact, and also the information is pushed to you rather than you having to chase it manually. Okay, so hopefully that gives you all a bit of idea, but to summarize, basically the online lenders are most likely not ADI, so therefore they will not be able to offer you a true 100% offset account. And also, if you're after some complex structures such as, for example, equity release, portability, different type of complex, or a bit more just than a vanilla type of purchase transaction or refinance process, then these online lenders may not be able to offer those loan features. Okay, so that's one of the points. And also the second point is that the customer selection criteria will likely to be very, very stringent. So just be careful that you may get declined. And also the last point is the communication can be a bit lacking with these online lenders, and you just need to make sure that you constantly follow up, and also have the expectation that it may take a while to actually have the overall process going through. So I hope that helps. If you like today's video, don't forget to give us a thumbs up, subscribe to our channel, or leave a comment below. Let me know what else you'd like me to talk about. But otherwise, I'll see you guys again in next week's Invest Power episode.